Now, as widely expected, the South African Reserve Bank has held its rate steady today. The repo rate will remain unchanged at 6.75%, while commercial banks' prime lending rate will stay at about 10.25%. Oil prices are inching up and new sugar taxes will take effect in April. But more importantly, South Africa's sovereign rating status still hangs in the balance.
The prospect of a sovereign credit rating downgrade, which would result in 3 major ratings agencies rating South Africa's local currency debt as sub-investment grade. The impact on the rand and long bond yields could be significant, but the extent to which a universal downgrade is already priced in remains unclear. Furthermore, the assumption in the forecast for the starting point of the rand at 12 rands 90 against the US dollar is weaker than current levels. The response of government to the intensifying fiscal challenges in the upcoming budget will be key to avoiding this event. In addition, the pressures are now even more intense, with several state-owned enterprises facing financial risks. The challenge for government will be to find ways to finance the deficit in a growth-positive manner, and at the same time, convey a credible commitment to structural reforms that can raise the potential growth of the economy. This would also support business and consumer confidence.
Well, let's get some insight and reaction to today's MPC's decision, where economist Ian Cruikshanks now joins us in South Africa. He's from the South African Institute of Race Relations. Welcome to the show, sir. Now, a number of factors have changed since the MPC's last November meeting. We saw the rand is now at a much stronger level. Inflation also expected to drop. What are your thoughts on today's decision and certainly the insights from the governor there?
Well, the decision to leave rates unchanged, I think that is the best possible decision we could have had. There have been a number of very positive developments. First of all, the rand's appreciation. It strengthened quite considerably, as we just heard a moment ago, from that cut from the Reserve Bank's governor. And that's been a big help in bringing down inflation expectations. And it's expectations which drives inflation over the longer run. So that's a positive move, and they've anticipated that. So while it is very much data dependent, I think that the developing of positive data has allowed them to leave it as it is. Could they have cut rates? No, I don't think so. South Africa depends to a significant extent on a foreign capital inflow, and if we cut our rates and close the gap between our bonds and, say, US Treasuries, that would make us less attractive. So, all in all, I think that this is the right thing to do, bearing in mind the risks that we have to cover at the moment. To have raised rates, no, it's not the climate for that. So therefore, we come back. It's very much data dependent. The data points to leaving it as it is, and that's what they did.
Now, let's talk a little bit about inflation. In November, we saw the MPC was wary of the inflationary impact of the rand's performance, and we suddenly heard a more hawkish tone then. What sort of tone did we get from the governor this time around?
Once again, as I said, it's very much data dependent, but he stressed, of course, that the rand exchange rate has made a significant impact. As an economy, we're very much dependent on imported goods, and of course that has a big impact on all capital expenditure, on a lot of consumer expenditure. So, the emphasis was to say, well, the stronger currency has had a big impact. Is it going to stay? At the moment, provided we don't have a sovereign risk downgrade, then it could well do so. It depends on a number of factors, like food prices, which have come down a great deal, of them stabilizing where they are, of the oil price not going even higher up than it has been. But with a combination, despite the stronger oil price, with the stronger rand, we've been able to cut our petrol price. So, that seems to balance out. And I think just looking ahead, he gave the impression that there was no immediate fear of an imminent rate hike. But we must remember the sovereign credit rating agencies, we're on a risk for a downgrade with Moody's, so their next move could be lower if we don't sustain the improvements that we have made.
Now, of course, politics has played a big part in the MPC's decisions. We saw the rand rebound after Ramaphosa won that ANC leadership election. Did you get that sense in today's decision? And certainly, did he seem positive about the future of South African politics going forward?
Well, he wasn't prepared to talk about politics from the sake of politics alone. What he was more interested in, I think, was what we call the Ramaphosa impact. That is, that what it has done is his winning in this election has in fact improved confidence. He spoke about the possibility that we could move towards more capital investment, more foreign capital inflow, and that would be a great help, and perhaps a drive then towards further job creation and also then to higher consumer spending. So it was a strong link that this confidence factor coming from Mr. Zuma's success could then lead to a sustainable improvement in the economy and in retaining lower inflation and keeping interest rates at their current level.
Certainly a cautiously optimistic outlook there. Well, many thanks for joining us, sir. Of course, that's economist Ian Cruikshanks in Johannesburg.